Michael Burry just sold all of his stocks except for one of them. So the question is, number one, why did he sell all these stocks? And number two, should you do the same? Ready? Let's dive in. If you're not familiar with who Michael Burry is, he is one of the most famous people who shorted the housing market going into the financial crisis. And in the movie The Big Short, his character was played by Christian Bale. Michael Burry has recently returned to the spotlight over the last few years, partly because of his political views, but also because of his calls on the economy since 2020. And the most recent move that he's made has been making waves because he sold all of his stocks in his hedge fund except for one. Now, because he declined to comment on this most recent filing that showed he went to all cash, we have to speculate a little bit and look back at the things that he's been saying to see some insights into why he thinks it's safer to be in cash than any investments right now. And it boils down to two main things about the economy, the first one being a massive increase in debt. He recently tweeted that net consumer credit balances are rising at record rates as consumers choose violence rather than to cut back on spending in the face of inflation. Remember the savings glut problem? No more. COVID helicopter crash taught people to spend again, and it's addictive. Winter coming. And we can see that indeed for the last few years, we have seen the total debt balance for households in America just grow, both non-housing and housing debt. When we break down the non-housing debt, we can see that whether we're looking at student loans or credit cards, auto loans, or other debt, all categories have been moving higher. Now, the fact that credit card debt is increasing is the most concerning of these because credit card debt is all variable interest rate debt. This means that as the Federal Reserve pushes interest rates higher, the credit card interest rates will also be going up. This means that even if you're not adding any credit card debt, just the amount of debt you have will be getting more and more expensive and harder to pay off. But on top of that, Americans are adding more credit card debt. So the total amount of debt is growing and the cost of servicing all of that debt is growing. Now, Michael Burry is pointing at this and saying that Americans are addicted to spending. Another take could be life is just getting so expensive and Americans have burned through their savings and people are forced to resort to their credit cards just in order to pay the bills. But household debt is not the only thing that he's pointing to. He's also looking at economic weakness overall, especially in the stock market. On August 12th, he tweeted that NASDAQ is up 23% off its lows, calling this a bear market rally because across 26 bear market rallies, the average is 23%. This means that the recent rally in the stock market, he is looking at it as a bear market rally, meaning a short relief rally that will be followed by another major leg down. Now, despite these two things, household debt explosion and a bear market rally seemingly being completely disconnected from each other, they're not entirely disconnected. In fact, they're more connected than you might think. In order to understand what's going on here, we do have to go back to the hypothetical caricature of a small, isolated, gold standard village economy. Imagine in this local village, closed economy, everybody gives their gold to the banker, and the banker issues paper receipts to the people to be used as money instead. In this local economy, no inflation would take place at that moment. People would just trade their paper back and forth just the same as they would have used to with gold. But at some point, the banker wants to make some extra profits, and so they start to lend money. If you were to go to your Aunt Sally to borrow money, that's a direct transfer and no money supply growth has taken place. Aunt Sally gives you her paper so she can't spend it herself. The same money supply exists afterwards as it did from before. However, if you go to the bank to get a loan, the bank is going to give you a new piece of paper. And that piece of paper also says redeemable on demand for gold anytime you want. Once the bank makes a loan, now you have an increase in the total supply of money. So Johnny can go spend his extra dollar without Aunt Sally having to give up spending her extra dollar. This means that as new loans are created, the money supply grows and there's more purchasing power going around the economy than there would be absent that fractional reserve banking. As that new money works its way throughout the economy, that's more spending power driving up prices by bidding up the costs of goods and services, which have not been able to expand as fast as the money supply growth. Stated very simply, fractional reserve banking lends money into existence, which pushes prices up because the money supply grows faster than the rate at which goods and services increase. But the reality is this money supply growth is built on debt. That was true back then, and it is still true today, which means you only need one thing to happen to unwind all those price increases. You need the debt to start getting paid off. Sometimes that's the result of the banker raising interest rates, and so the people who have the debt outstanding decide it's too expensive to keep the debt, so they start to pay it off. As they pay that debt off, that means that there's money now leaving circulation because I have to go out, provide value, do labor, do work, get money from the economy, turn around, give it back to the banker. Now that money's not in circulation anymore. So the money supply decreases, the goods and services stay the same, which means now you have prices start to collapse. This also shows that you don't need interest rates to be at any specific level relative to inflation to spark the unwind from happening, meaning we don't need real rates to be positive today to cause deflation or at least to stop inflation. All you need is to stop the growth in the money supply, which might only take a very small increase in interest rates, even if they're still negative on a real basis. The other thing this shows is you don't need a significant increase in interest rates. All you need is it to be significantly painful for the debt holders. And considering that non-housing debt for households is at all-time highs, and that interest rates are getting pushed up now from all-time lows, it's no surprise that Americans are feeling the pain and feeling the squeeze more and more because you've got record high debt at the lowest interest rates they've ever been. So even the smallest increase in interest rates can make it more painful for you to have to pay that back, and sometimes impossible for you to be able to pay it back. And so due to the fact that we do have interest rates still moving up and we have debt loads at the highest level they've ever been, Michael Burry sold almost all of his holdings in anticipation of the coming deflation in asset prices that are going to reflect the economic burden that this debt is loading up on our economy. Now you might be thinking, well, isn't it too late for this? Because these 13F filings that hedge funds file, these trades could have happened months ago. And that is true. But one thing that many people know about Michael Burry is that he is historically early to moves. And given the fact that all the major stock indexes are still up 20 to 25% off their lows from a month or two ago, if he ends up being right about this, we probably do have some major moves down from here. And if you would like to be able to protect your investments from major crashes like that, I've got a whole course designed to teach you exactly how to bulletproof your portfolio. Link is in the description below. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.